I am Daniel Lucas, and welcome to Book 101 Review. Book 101 is all about the books that I read for the last 40 years. And today I have my special guest. He is a CPA with tax and accounting expertise, no other than Mr. Douglas Carpenter.
Pleasure to be here. Thank you for having me on.
Welcome, Mr. Douglas. And can you please introduce more about yourself that I miss?
Sure. If you can't tell, I have a lot of experience in accounting. I have about 35 years in the business. I started out actually in finance as a broker. I didn't like that as a career, and I went into accounting instead. I got my CPA. I've worked my way up in accounting. I also have worked in finance. I'm a CPA and a chartered financial analyst as well. I've been a CFO for a number of companies, the most significant of which I was CFO for New York Stock Exchange Company for 12 years, and then opened my own practice. Actually, I purchased a practice in the accounting sector. We do accounting and tax, and we have a specialty in particular tax savings. So we go a lot further than just doing the returns. Most accountants do the returns, and that's what you pay them to do, and that's fine. But we offer services that go far beyond that. We just take a holistic approach, particularly to small business owners, but we service everybody, and that is to save them on taxes.
Mr. Douglas Carpenter, thank you so much for sharing your knowledge and wisdom to the world. And today let's talk about completely legal extreme tax savings. So tell us, how do you define extreme tax savings in a legal context, and how
Well,
it is fundamentally different from conventional tax planning or, on the other end of a spectrum, tax evasion?
okay. Well, tax evasion you never want to be involved in. You never want to do. There's a lot of things that you can do legally. The tax code is very complicated. There's a lot of things that people can take advantage of that they may or may not know about. There's some basics, and financial planning is important, and that does cover some ground in the tax realm. Such things as 401k plans and IRAs. These are what we see most people doing. It's a very good thing. If you have children, there's additional things that you can do. There are college savings plans. There are ways that you can get deductions for tuition in certain instances. You can get interest on student loans deducted if you do things right. And there's a lot of ways to do that. Again, we cater to a lot of small business owners, and the structure of the business matters. Sometimes you may want two different businesses, both with different structures. They do different things. One may do one aspect of something, one may do another. I'll give you a very classic example of something. Let's say you run a retail business, be it a restaurant or whatever it is, even a retail store, and then you own the property that the business is in. You would most likely have that property in one type of entity and the business running out of a different one. There are tax advantages to doing that, and things that you can do, things that you can write off in one that you may not have as liberal write-offs in the other.
Very well said, Mr. Douglas. Very well said. You emphasize these strategies are completely legal, thus achieving this level of savings require a shift from reactive compliance.
I have a list of more than 50 ways, 50 little items that we check off for each of our clients to make sure that they're taking advantage of it. Not all would apply to everybody, but it's a checklist that we go down to make sure that they're doing it. I've yet to come across anybody that is even close to the maximum tax savings that they could have, or they just haven't configured it right. There's also some check boxes that people could run afoul, and they don't realize they're running afoul. And they need to know that. I'll give you two examples. Both involve FinCEN, which is the basically financial crimes is what they investigate. And it sounds like a crime, but it's just something people forget to do. One is having foreign accounts. If you have a foreign account, you need to report that. Doesn't even mean you owe tax on it. You may or may not, but you have to report it, and there are very severe penalties if you don't. That's one. Another one that comes up sometimes is if you receive a lot of cash. If you receive over $10,000 in a cash business and cash payments, you need to report that. Again, nothing illegal about accepting that, but you have to report it. There are certain requirements. And taxpayers sometimes run afoul of the tax laws by not making these reports, even though they don't owe any tax.
Interesting indeed. And is it or is the primary goal of these strategies to preserve existing wealth, or can they be actively used as a tool to create and grow new wealth?
Both. You look for, obviously, you want to, with taxes, you want to retain a cash flow. There are ways of doing that. It's particularly effective in real estate transactions. You can go from one real estate, flip it, and go to another. That's and do a 1031 exchange. You won't pay the capital gains, and so you ultimately sell it off. In wealth management, though, you also have generational wealth, and passing down that wealth is important to understand the rules that dictate how that's done. Now, they've raised the inheritance tax up to a limit where most people wouldn't even have to consider it, but some do. Some of our clients do. It's very important that there's tax planning in place. It's also a good idea, something I see may not even be in the tax saving realm, but it's very important to plan for your taxes and plan how money will get passed along. Often one of the things I see, and this is a very, very simple thing that any one of your listeners can do right away, is that if you have financial accounts, make sure there's a beneficiary on that account. It makes it extremely simple if something happens to the owner of that account, for that account to just be claimed by the beneficiary. You don't need a will to do that. It bypasses a will, it bypasses probate. Very often I see people, they didn't realize that they needed a beneficiary on something, and all of a sudden it has made it extremely complicated.
Extremely complicated indeed. And how critical is the choice of business entity as the foundational first step for implementing advanced tax strategies?
It is, I would put it as moderate. It's very important, but from a tax effect, a lot of things can be moved around or corrected later on, but you really want to start with a good foundation. The main entities that you may have are a single member LLC, which is what basically a sole practitioner might have. You could have an S corp. You could have a partnership, which is basically it's a single member LLC with partners, or you could have a C corp. The most complicated of those is the C corp. There are rules in place. There is double taxation on that, but it was reduced significantly under the Trump era. And it's actually competitive now with the S Corp and the partnerships. Usually I'll recommend an S Corp, but from an operational standpoint, some businesses operate better under a partnership. With an S Corp, shareholders have to be treated exactly the same. With a partnership, there's flexibility within that. So it depends on how you operate and what type of business you have. A C Corp is always a consideration, particularly with a larger business and with an exit strategy, which is also not just when you buy and own the business, it's when you sell it too. And with C Corps, there's some significant tax savings on the sales side should you decide to exit in 5 or 10 years.
How can strategic deferral of income, not just postponing taxes, but strategically controlling when you pay them, create a massive long-term advantages?
There are things that you can do. I mean, I'll give one example of something that can be done. Let's say you have a C Corp, and you don't want to claim income for whatever reason. You have 4 kids in college and you're looking for financial aid, and you don't want to show that you make $1 million a year. There's a way actually of paring that down. If you have a C Corp, the C Corp will be paying the taxes. You will receive a salary out of that C Corp. So that salary might not be the $1 million that the C Corp earns. It'll just be the $150,000 that you claim as salary. You do need to pay yourself a salary. It should be within the realm of of what you do. But that was an example. Now, you run into a second problem, and that is you accumulate too much cash in the C Corp. The IRS doesn't like that either. When you pay the C Corp out, you'll recognize the income to yourself, and you'll see it as a dividend. You'll pay tax on the dividend. Generally, the IRS will allow about $235,000 or a business reason for a company to accumulate more. So what a person can do then is borrow from the C Corp. They're not going to pay tax on the borrowing. They will have to pay interest back to the C Corp, but it's a way of using the money first and wind up paying tax on it later. There's ways also to insure that through life insurance, and ultimately it's possible to not pay the secondary tax, the dividend on that at all if it's structured in a particular way.
Mr. Douglas, what are the examples of legitimate but often overlooked business deductions that can drastically reduce taxable income for entrepreneurs and investors?
To me, most of them are very obvious, but I very often see people not do what I consider to be the basics. One is pass-through entity tax. That is when you're paying your state tax through the company, and it allows you a significant deduction, the deduction for what you're paying on your state tax off of the corporation, which then becomes a credit on your tax return. That's one. I see people not paying their health insurance through the company. That's another big one that I often see. You can basically deduct it from the company, and depending upon whether you're an S corp or a partnership, it's treated a little bit differently, one entity to the other, but generally it's tax deductible as well. There are things you can do for long-term care insurance that can be deductible to the company, particularly C corps. There's some special rules with C corps that allow long-term care insurance to be deducted, but other businesses can do it as well. I mean, these are just home offices. People are all afraid to do a home office because they think they're going to get audited, yet they're working. They have a dedicated space in their home. As you can see, I do. And there's certain deductions you can do. The idea is to do it legitimately. The other thing is to keep records. Auto is something that is deductible, but you want to keep records of that. There are apps on your phone you can do that will record your driving habits, and you can segment what's business, what's personal. And these are the things that you should do. So you shouldn't be afraid to take any deductions that you're entitled to.
How can you leverage difference in federal versus state tax codes or even international tax treaties to your legal advantage?
International is extremely complicated, and there's a lot of rules that apply. I really wouldn't even want to get into that here. The state and federal, though, is usually the states mirror the federal, and then I always say there's a list of exceptions. Each state is different. You have to know the U.S. has roughly 51 tax codes. Some states like Florida don't have tax, but generally there's 51 tax codes to be aware of. The federal takes the lead. The states will sometimes recognize it. Also, there's tax credits. Like, for instance, the R&D tax credit. This is an old credit that's been around for a long time. There's 4 qualifying questions you'd have to have if you do it. If you're inventing a new product to take to market, you could have R&D. You could get a credit for that R&D. It's not a one-to-one, but it's a partial credit. A lot of states will follow that. Like California will give you that same equivalent credit. Other states will do a partial. Some states won't at all. So.
Okay, interesting indeed. Mr. Douglas, how can the thin 1031 exchange for real estate be used beyond simply swapping one property for another to create a powerful multi-generational tax saving engine?
Well, that goes into wealth management, and that is, let's say you start with a small property and you grow it, you flip it, and you do a 1031 exchange, and now you ultimately grow that into a very large amount. Let's use a number, say $5 million. You've grown it, or $10 million. You may have a very large capital gain in there built in. You only started with a small amount of money, maybe a few $100,000. You might have millions of dollars in gains in there. But what could happen? I mean, we all eventually have to pass this on. If that's planned right with the right wealth management, that can be passed on to heirs with a step up in basis. So what that means is the current value of the property, whatever it is, at that time, it then becomes the basis for the estate. No tax is ever paid on that. So they say you can't escape death and taxes. With the 1031 exchange and the right planning, you might be able to escape the tax part.
Mr. Douglas, what specific types of professionals, proactive CPA or tax attorney or a financial planner are essential for building and implementing these strategies correctly?
I have to say, I think all of them add value to the equation. I work with attorneys all the time, tax attorneys as well. Yes, I'm a CPA, but I don't claim to know everything in the world, particularly from the legal standpoint, the trusts and the other things. I work with attorneys all the time to do that. We become a team to do that. I work with financial planners as well, and we all have our input into that. The one question, though, that I would say any taxpayer should be asking themselves is, are you engaging the right professionals, and are you engaging professionals at all? I have people that, they go into their to get their taxes done each year, and they think they're getting tax planning. That is not tax planning. They may be nice. The person you're dealing with might give you some tips and say, hey, you should put more money in your IRA, or do this and that. That's not tax planning. Tax planning is much more formal. It's a sit down. It's rather, at least from my perspective, it's expensive. I mean, I charge a good amount I charge a lot more to do tax planning than I do a tax return. So, but it's also extremely valuable. And if you only pay me for a tax return, I'll pitch you on the rest of it, but you've got to pay for the planning to get that.
Very well said, Mr. Douglas. Very well said. And what is the most common and costly mistake people make when they try to implement advanced tax strategies without proper guidance?
Well, first of all, I'll say waiting to do it. And second of all, know what you're doing. Don't, this is not a place to save money or think you're an expert. I study the tax code several hours every day. It's just something I do. It's just when I have free time, I read stuff, I sit at night, one eye on the TV and another eye on a tax guide. It's just what I do. And I will tell you, I learn something new all the time. It's just that way. It's a very complicated thing. I get newsletters, probably three newsletters a day come in my mail that I read and go through just to make sure I'm up on everything. Things are always constantly changing. I think the biggest mistakes people make, one is they apply yesterday's tax knowledge to today's tax code. They think they know something. They heard it from someone. It was right 5 years ago. It's not right today. And the other thing is they don't take a holistic approach. They try and implement things and they do these one-offs and these shots and not looking at the large picture from an overall financial perspective, where they're looking to go with their goals in life, what their financial needs are in the future, and how that plays in. I can't tell you how many people I sit down in front of. I'm the first tax planner they've ever sat with in their entire lives. And I can go back 5 years tax returns and show them hundreds of thousands of dollars they missed out on in savings.
Mr. Douglas, before we wrap up our discussion for today, I'm inviting you to please do listen to my other podcast, because my abstract essay is already in 5th season, abstract poetry in 2nd season, and my food 101 in 5th season as well, geography 101 in 4th season, and food 101 in its 5th season too, geography 101 in 4th season, and my baby podcast, Law 101 and Mental Health 101. Love Letters in its 3rd season, and Movie 101 Review and Music 101 in its 4th season as well, and Science 101 and Sex 101 in its 1st season. Please listen to them wherever you listen your podcasts. So, Mr. Douglas, is the end goal of this simply is to keep more money, or does achieving extreme tax savings unlock a greater capacity for investment, philanthropy, or legacy building?
I mean, if you like to give your money away, that's fine. There's an old saying that billionaires don't pay taxes, and you know what? I disagree with that. Billionaires do pay taxes, but billionaires don't overpay taxes. You
Yes.
shouldn't overpay your tax. If you owe the tax, pay the tax always. Tax evasion is not something you ever want to do. Be honest about it, but take advantage of all the things that you're entitled to.
Definitely. And for a business owner or investor listening who is tried or tired of overpaying taxes, what is the first most impactful action they should take to explore these possibilities?
Take a very hard look at their current tax return. Really read it. Really understand what each line is telling you. If you're paying a tax, understand what that tax is, and then see what bracket you're in. If you're in a higher bracket, imagine what a lower bracket could do. What taking $50,000 off your adjusted gross income, where that would put you. Usually, I can do that. I can come in and do that. It's again quite legally. It's just making sure we're applying all the areas of the tax code to what you do. The other thing is that some of this does, the caveat here, is some of it does take investment money. If you have no money to invest or no money to take advantage, it's more difficult to get the tax savings. So usually most of the people I have do have investments. They do have some spare cash or cash flow to direct towards tax saving strategies.
Mr. Douglas, thank you so much for sharing your knowledge and wisdom to the world. So, can you please invite our listeners to support your business, your advocacy, or whatever projects that you're doing right now?
Sure, our company is Comprehensive Hospitality Solutions. We specialize in hospitality, but we service all businesses. Our specialty is in tax. You can reach us at the number that you see. We are at solutionsbychs.com, www.solutions with an S by BYCHS, Charlie Henry Samuel.com.
Yes, people, let's support Mr. Douglas Carpenter because if you support him, for sure, more and more empowering entrepreneur that will save their tax. So, Mr. Douglas, thank you so much for your time.
Thank you so much for having me.
Modicon people, see you soon.